Previously, he was the director of SGS Techniques Manufacturing Private Limited. Mr. Vijay Agarwal, Chief Financial Officer. Vijay, he handles the financial operations of the company and has approximately 16 years experience in finance and business starting. We also have with us my fellow bankers, Mr. Deepak Manu from ICICI Securities and Mr. Kunal Bajaj from ICICI Securities. I'll not take much time explaining the company to you, but given the phenomenal journey Syrma had, it is worth mentioning. Syrma SGS Technology Limited is a technology-focused engineering and design company engaged in turnkey electronics manufacturing services, specializing in precision manufacturing for diverse end-use industries, including industrial appliances, automotive, healthcare, consumer products, and IT industries. Syrma SGS is one of the fastest-growing Indian headquartered electronic system design and manufacturing company. Further, they are leaders in high-mix, low-volume product management and are present in most industrial verticals. The company has a track record of technical innovation that involves working with the engineering team of their market customers. And over the years, they have evolved to provide integrated services and solutions to OEMs. From the initial product concept stage to volume production to concept co-creation product realization. The revenue from operations as per the performance in the financials for fiscal 2022 was INR 12,666 million. For fiscal 2021, INR 874 million. And INR 867 million for fiscal 2020. About the IPO, this IPO is a combination of fresh issuance aggregating up to INR 766 crore, offer for sale of equity shares aggregating up to 33.69 lakh shares, equity shares. Price band is INR 209 to INR 220. The offer size at upper end of the price band will be INR 840 crores. Issue opens to public on Friday, August 12, 2022 and closes on Thursday, August 18, 2022. We have received strong interest from market domestic as well as foreign investors, which is a testimony of how investors acknowledged the journey of this company. I will now hand it over to the moderator and thereafter the management team will take you through the business presentation.
Thank you, Mr. Negi, for the introduction to Syrma SGS Technology's initial public offering and the issue's key highlights. Electronics production in India is estimated at rupees 4,975 billion in FY21 and is expected to grow at a CAGR of 32.3% to reach 20,133 billion by FY26. I would now request the company team to take us through the organization's journey, its struggles and victories, subsequently take the attendees through the company's investor presentation, cover its business and financial details, as well as touch upon its key strategies going forward. Over to you, Mr. Kannan. Sir, you're on mute.
Sorry about that. So just a brief intro. I've seen this industry, grow from the 1970s, late 70s, when I saw my father build out electronic manufacturing for the PC industry. He had designed the first double-sided floppy head, which went into the first floppy drive in the IBM PC. So I'd seen this industry grow, but India unfortunately missed that boat, and most of that manufacturing ended up moving to Taiwan and China over the years. And now after 30 odd years or 40 years, I'm seeing India has this huge opportunity. It's a large industry, and for once our market is prime in the sense we are a big consumer of electronics, as well as we have the talent pool that has served a lot of customers in design of electronics. So between that is creating a lot of interest for sourcing manufacturing from India for world and for India's needs. So that's why it's a very exciting time for us, and we're seeing the benefits of that driving a lot of growth in the past that we've seen with our company. I really see this as an opportunity for India to shine and serve the world, and we see that it's something that will play out over the next 10 years because the growth horizon of electronics entering everyday products is huge, and we see that in day-to-day lives of ours, that how all-encompassing technology and electronics are going to be moving forward. We can start the presentation, or
we'll go ahead with initially going through the corporate theory, and then we can move on to the presentation. Backend team, request you to please play the corporate audio visual of the company.
Syrma SGS Technology Limited is one of the fastest growing Indian headquartered ESDN companies among the large bouquet of EMS players in India. We are one of the leading design and electronic manufacturing service companies in terms of revenue in fiscal 2021, engaged in turnkey electronics manufacturing, and we are leaders in high-mix and low-volume product management and are present in most industrial verticals as per the FS report. We currently operate through 11 manufacturers in Tamil Nadu, Karnataka, Himachal Pradesh, Uttar Pradesh, and Haryana, facilitating us cater to the requirements of our customers in North and South India. Our manufacturing facilities are strategically located in Tamil Nadu, Karnataka, and Haryana, which allow us to cater to our export requirements in light of the proximity of these facilities to the respective city airports and Chennai port. Our manufacturing facilities in Tamil Nadu are located in a special economic zone. Our facility in Haryana is set up under the Electronic Hardware Technology Park scheme. Our plants have received accreditations for quality management, environment, and health and safety system. Our current products portfolio are classified under PCBA, RFID, electromagnetic and electromechanical parts, and other products. Apart from India, our products are sold in over 24 countries including the USA, Germany, Austria, and UK. Our product portfolio has helped us forge strong relationships with our major clients spread across the world. In 2018, we have set up our zone of autonomous creation in Chennai, enabling us to execute quick prototyping services after a design concept is provided to us by our customers, helping them create an early form of the final product. This facility has a dedicated line for PCB assembly with an autonomous team that has procurement, process, quality, and new product introduction engineers independent of our manufacturing facilities. We have 3 dedicated R&D facilities equipped with state-of-the-art infrastructure. Our quality control procedures are undertaken by an independent quality control department, responsible for ensuring stringent quality for incoming supply, process quality, and finished products. QC is the cornerstone of the business operations. Our exclusive skill development center across all our facilities and offices play a crucial role in developing and retaining talent. We have been certified as a Great Place to Work by the Great Place to Work Institute India in 2020 and also have successfully implemented initiatives towards women empowerment. Over the years, we have received several awards and accolades for excellence in various sectors.
Thank you. Would now request the backend team to please display the investor deck and would request the presenters to please take us through it.
Next slide, please. Next, please. Yes. So good evening, everyone. As explained by our bankers, our total issue size will be approximately 840 crores at the upper price band. Our issue opens on 12th of August 2022 and closes on 18th of August 2022. Go ahead, please. Next slide. Sunny.
Yeah. So, just to give you a sense of what we are, we are a manufacturing design services company where we work with our customers all the way from product conceptualization. So, if there's an idea that a MNC or a brand wants to develop, we'll work with them to help them take their design and make it real. That could be as much as design the whole product, but it could be as simple as they already have the design. We have to make sure that it is manufacturable, it is sustainable in the sense of it can be repeatable, and it's an excellent quality product. So product conceptualization, make the prototype, and then new product introduction, which is called sample batch building, and then mass production, and then life cycle management of that product. So most of our customers across industries work with us at different stages of the life cycle of the product, but we take that up with a more engineering design mindset than just assembly mindset. So we are kind of a partner on the back end with our customers. So we are across a multiple segment of industries, where industrials being a large chunk, but also across consumer, healthcare, and telecom and IT as well, and auto also. So with that spread, we are quite de-risked across the different verticals. Like I said, strong R&D capability helps us work very closely with the customers. And also, we've been export, about 50% of our turnover is export-led. So that also helps us engage with customers more deeply because we get exposure to international manufacturing practices as well as quality control systems that over the past years that have made us a stronger manufacturing partner. The guts of what we build, Syrma actually stands for wire in Greek, and it's also the main star of the Virgo constellation. But what we do is starts with the wire. The core of what we do, even in circuit boards, the wire is etched. In other places, it's physical. But what we build is printed circuit boards. RFID, which is a subset of IoT's radio frequency ID tags, and also electromagnetic and electromechanical parts that are the core of managing power across electronic circuits. So that's where our strength lies, but we are spread across all the industries. One thing that we drive is high mix, lower volume. So we don't play huge volume product. We play mid-size to low volume product where we can add more value through managing the supply chain also for our customers. We try to focus on margin and of course growth is a key driver, and also the diverse products that we have. We have 3 decades of experience in this industry, and we have a management team also that's very strong. Next slide. We have plants across India, north and south. They're not huge scale plants. They're mid-sized plants, typically ranging from about 60,000 square feet to 120,000. But the main idea being that you want to de-risk India in the sense India cannot be the same way as one mega plants where you have to move a lot of large workforce over. So we try to keep plants closer to where the workforce is or where the customer is, and that's how we have had multiple plants across India. And we have plants in the export processing zone for specific export purposes. We have plants in Krishnagiri where workforce is abundant, so we're closer to the workforce. Bangalore, similarly, customer closeness, proximity, and across the Haryana belt in Gurgaon, Manesar, and Bawal, and of course, Baddi. Engineering has been our strength. We have about 106 R&D people that are part of our design team. We have design centers in Chennai, Gurgaon, and Germany where we can work very closely with our customers. About 27% of our revenue comes from ODM, where we call original design manufacturing, where we actually have rights of ownership of the design with the customer, because we co-created or self-created this product for them, that is the building block of their product. So that has been a big piece of where we play, and that has been a strong engagement methodology with our customers. Which I mentioned, we manage the entire supply chain also for our customers. So we have a large supplier base, about 1,700 suppliers across the world, US, Singapore, China. We manage the audits of these customers, make sure that incoming audit as well as their plant audits are done by us to ensure quality products are received by us as well. In addition to all the certification our plants get, we also get certified by our customers, which is quite a lengthy process for the customers visit the plant and approve the plant to meet all their requirements, all the way from quality control, product traceability, government requirements, as well as employee safety, and now new sustainability ESG requirements. So our plants always get certified to all these critical things from these major clients because they require that for moving through their supply chains. And this skill has been developed over the years. And also we have been accredited by all the ISO and relevant quality certifications for all the different products that we build. Next slide. This 2x2 matrix kind of gives a margin profile of where Syrma plays. If you look at the left end of the 2x2, it's high volume, low margin would be mobile phones. We don't play in that space. We try to go more in the more boring electronics as such. White goods, lighting, automotive, telecom, industrial, and RFID, IoT, and medical devices where we play, as well. Next slide. Judge. You're on mute, sir.
Yeah. In this slide, we are trying to capture the landscape of our customers in the industry verticals. Some of the customers who have allowed us to share their names, we have put them on this slide, but there are not many more customers equally big in other verticals. Now, the ethos of the management of Syrma SGS has been to tie up with the market leader and grow with that market leader. So all of our customers would be market leaders in their verticals. Some of them are listed over here. As Sandeep was saying, we get along with them right early in the product conceptualization, design, team-changing stage, which gives us the stickiness. One of the philosophies of the management has been to de-risk the business, which has resulted in none of our customers having more than 10% of our total turnover share. And also the business is spread across verticals, whether it's industrial, consumer, automotive, healthcare. We have a very strong footprint in automotive sector where we are supplying to almost all the leading brands in the country, whether it's combustion or the emerging EV market. In power management, we are with again the leading companies, which are some of which are listed over here. And our products which we make touch the life of an average consumer citizen every day, whether it is lighting, whether it is water filtration, air purification, power management for the UPSs, the toll access road which we give the cars with the toll access, heating. So we are spread across and we have grown fast. The stickiness of the customer is something phenomenal to us. Almost 16 customers are more than 10 years. And in fact, one of the customers listed out here is with us for 32 years. And we try to control the wallet share of the customer, which means that once having entered a customer, we grow with that customer by increasing the volume of the product which we are supplying or getting in other models which he is making. So this has ensured a secular high growth rate for the company over sustained periods of time. Next slide, please. Vijay. So during FY 22, we did a total revenue of approximately 184 crores and delivered an EBITDA of 143.7 crores, which is 7.3% EBITDA margin, and earned a PAT of approximately 76.5 crores. As you can see, there is a benchmarking with few competitors here, and it can be observed that we have a high EBITDA and PAT margin as compared to our peers here, specifically mentioned. And we can see there is a much higher exports in comparison to the other peers. In our case, export is contributing almost 43-44% of our total revenue. RFC for us is approximately 19.1% during FY. Next slide, please. Wanted to talk about the industry in which we operate. As you can see, India's EMS market or India's EMS manufacturing so far was contributing less than 2% of the overall global EMS manufacturing. So India's EMS manufacturing so far was approximately $14 billion till FY21, which is now expected to grow up to $81 billion in next 5 years' time with a CAGR of more than 40% per annum. And we believe this is a huge market to cater to, as we currently operate in a non-mobile EMS segment, which is roughly around $25 billion market size for us, which can be around $25 billion market size in FY26, which is a more focus area for us. Next slide, please. Sandeep, you are on mute.
If you see what's really happening in this industry as such is so what you can see that's happening in this industry right now as such is there's a huge impetus by the government. For the first time, we're seeing that they're not swayed by any single lobby group to change duty structures to make it easier to import some specific product. They have a uniform policy that they want to make electronics in India. I mean, generally make in India, but electronics more so than anything, because after oil, the biggest import of the country is electronics. So between PLI and other incentives, they are quite clear. They want to make sure that electronics get made in India, and that even though we don't assume any kind of benefits of PLI in our projections, but we really PLI puts our attention from the customer base and other places that this is India is serious to do business, and they really are keen that investment comes into the country, and that has just created a very interesting environment right now for electronic manufacturing. In addition to PLI, also the other treaties like FTA, they're being very cautious that are there really electronics being produced at the value adds that are of the norm. So that is creating another barrier that we want to make sure that everything is made in India as much as possible. The other thing that has happened during COVID, generally the way the world realized, the global world realized that it's not so great an idea to just rely on one destination for all your products. So a couple of things changed. China has become one country rather than multiple provinces. So that has changed the story from that point of view. And also China is moving up in the world. They don't necessarily want to be just a factory to the world. And then thirdly, the world saw that our dependency of China could cause risk in the supply chain. So most MNCs globally on their electronic buys are strategically saying we need an alternate. Of course, Vietnam is a very interesting alternate, but Vietnam doesn't have the depth and the skill base that India offers. So that has created a very nice positioning for India to be able to serve the global markets. So most main brand names are looking at India as a potential for their global buys. So that is an interesting thing that has happened. India will serve the low-cost country portfolio, as well as they're also looking at nearshoring as in moving some production closer to where they are. So those are the two things happening with the China plus one strategy from the corporate side. And in addition to that, what we're seeing is that India has already done a great job in being the technical partner to most of these companies, as in helping them design product with our IT services credibility that we offer. So that has eased the credibility part for India, and we are able to serve that need very well. On the import substitution, we are seeing with the India wanting to have these products made in India, and the people who are looking at ideas for India by India shouldn't necessarily have to go to China to have it built. I mean, in reality, cost-wise, China labor is 3 times that of India's labor. Infrastructure, power, we are very, very close. In fact, India might be cheaper now. what is missing is the supply chain. I mean, China has a huge edge on the supply chain. We estimate that to giving them a benefit of 5 to 6%, but the government is trying to level that with the PLI benefits that you're getting. And of course, with the attention from global players that hey, it is okay to develop a new pipeline for supplies, that will enable India to be a supplier to the world and itself. So is a huge change that from what I've seen in the past that has happened. It was never there that, singular focus on having things made in India. What opportunities we are seeing in the EMS market is, of course, the EV, which is out of the blue, which is growing quite fast for us also. It's still a very small segment, but we're seeing a lot of inquiry and growth in that segment. Telecom, both 5G as well as product CPE equipment, that is quite a strong growth coming, which is also just a starting area for us. One area that through RFID, we are strong along with RFID IoT is where we feel that there will be a lot of growth as in intelligence being added to all the products that are out there. I mean, humans talk to humans creates huge mobile phone opportunity, but machines talking to machines will create an even bigger opportunity in IoT. And with RFID, we have the basic one, and then in addition, there will be a whole bunch of other technology that we are working on that will develop towards IoT requirements. Consumer appliance continues to be strong for India. We are present in water purifiers and washing machines, and that growth will continue. And a lot of things on the energy products, that is energy controllers as well as energy meters, that we're seeing a lot of growth coming for us. Next slide. Rajiv.
See, apart from three of us who are representing the company, we have a very strong, solid, committed management team at the senior level consisting of technocrats, top trades, management consultants, marketing professionals, supply chain specialists. So each of the areas is manned by a domain expert specialist, which enables us to have better productivity across all functions of the company. And the senior level management has been with us for long years, 10, 12, 15, 20 years. And going forward, we are planning to further strengthen the team as we grow to take care of the growth plans of the company. Next, please. In addition to the senior management team, what we've done is we're trying to have a solid independent board with, again, domain specialists, technocrats, legal, HR specialists, corporate governance experts, ESG experts, new idea guys. So we believe that this independent board would be a big help to the management as we scale up in the coming years. Next, please. Next, please. Yeah.
So, like I said, there's a huge inflection point that we're seeing in Indian EMS industry. It's akin to what happened in for the IT services industry with Y2K, right? When Y2K happened, it was a spotlight that, actually Y2K business was very small, but what it did, it enabled India to be a service station for the rest of the world and gave Indians the credibility and the chance to win that business. So that's the same kind of scenario we're seeing. Of course, manufacturing is a lot harder than this plain IT services, but it has different touch points. But we believe this is a huge opportunity for India. Maybe also in addition, like I said, government support is there for the first time. That is huge, as well as our talent is very, very accepted and of the caliber that we can serve the world needs. So with that and our manufacturing strengths that we have, I think this is a great time to be in this industry. We have been selected for the PLIs for telecom and networking and white goods. They also offer some growth for us in the sense part of the investments are going towards those PLI schemes, and also we have close customers and we started supplying those. We've been serving marquee customers, and due to that, they have taught us how to be better at what we do every day, and we keep getting better every day. our teams that have deep experience, I mean, years of experience in this space, as well as, the board. We want to be the leader in governance and quality of how we manage the systems and processes of the company. And that's why we've kept this, very strong view on looking at the growth coming and how to manage it with the teams that we have. Next slide. So what we really want to do moving forward is double down on our plants, make them, our existing plants, invest in them, our new plants, build them, our people, invest in our people, build better capabilities around our existing people and new people that we want to bring in. Pursue inorganic growth through customer alignment. So that means that if a customer requires us to be closer to them, geographically that might require an acquisition, we could look at that, or a technical capability that they would like us to add, we will look at that. So inorganic growth only through specific customer requirements that come over the time. We want to expand our customer base, bring in more customers that we can serve meaningfully and be a critical partner to their manufacturing needs, as well as look at our current customers and go deeper with them. So we want to go current customers where we are a small percentage, but we are high quality supplier to them. We see a huge opportunity to go deeper and win more business with the existing customers. But we want to, keep catering to new products and new development which will keep coming in the future that we see with electronics being such a huge requirement in, every area of our lives. We feel that there would be huge opportunities that if we co-create, there would be interesting opportunities. Especially like design coming from India, Indian companies that want to build is a huge option coming up that we're seeing. Vijay, you want to take over?
Yes, please go ahead. Next slide. Next, please. These are pictures of the products which we manufacture under different industry verticals. Few of the box products which we manufacture, few of the RFID products. Go ahead, please. And then the snapshot of the last year. Go ahead, please. Thank you.
Okay, thank you. So we'll jump into the Q&A session with this. Thank you for taking us through the presentation. We hope the attendees have captured enough and more understanding about Syrma SGS Technologies' business model, financial and its execution capabilities. Before we open the floor for the participants to ask questions, I would like to reiterate, you type your name and organization details in the Q&A chat box for the moderator to take note and address your query. Not in the interest of time, we will be restricted the questions to 50 to 20 questions only. Repetitive questions will be skipped. Coming to the first question, gentlemen, there's a question which is in that you have 11 manufacturing facilities. What is the need to have so many plants?
I think I addressed that in my presentation, but I will say it again. Smaller plants means less risk to customer when we are, some kind of disaster recovery is much faster. So every plant has a specific reason to do what it's doing, where it's doing it. So, but of course, over time, we always will keep optimizing, and for cost reasons, we optimize and bring down one plant and increase one plant. That continues. But we have seen that India is not square kilometer size plants, because if you have some issue, you are completely shut down, which is very risky when you're single source with our customers. So we try to keep redundancies all the time. So that's the reason.
Moving ahead to the next question, isn't there a huge risk of imports from, say, China in the products segment that you're operating in, because the products don't look to be very high-end in technology?
So, the looks can be deceiving. I would just say that, because what you see is not necessarily, something it's not sold by the kilo, if that's what you're thinking. These are specifically designed for a specific purpose, with specific outputs, with a specific tester that we've made to test on it. But yes, can China do it? Of course, where there's a will, there's a way. But I mean, you have to see, there are multiple products. It's not a single SKU that we are building. There are multiple SKUs, multiple capabilities that have to be managed. So it's not so easy that you just say China can take this tomorrow because China can take everything, but it doesn't work like that. There's a lot of engagement with the customer. So when customers engage with us, right? So then for them to move, it is a huge cost also. So if they're moving, they should be, I think, less than 30% saving will never even start the needle. So really, there should be some really innovation that drives complete difference in product. And at that time, then if China really wants to go after my business, why won't they just go after the end customer's business, right? That's much more valuable. So that's what I would say.
Thank you, sir. Since you've been into it from idea to execution, could you just explain a little bit more on the technical innovations front? How does the journey go?
So we work with ideas, right? We love working with new ideas. So for instance, it's at the cost of margin also because some of these ideas never fructify, but what you see is what we do. In the sense that the customer out of Germany who wanted to develop a German-speaking toy that could, specifically connect without the internet and tell a story to a child. And we built that out and designed it completely from scratch. And now we are shipping millions of those products for just the German-speaking world. So, opportunities lie everywhere. It's just a matter of getting the right product and the right price and bringing it the right way to the customer. Similarly, a startup out of IIT Bombay wanted to make PC brushless fans for the Indian market. We partnered with them from day one and helped them take that idea to market, and they've grown very, very well. So like these, you don't know where ideas exist. They always come, and if you're open to, help them come to the world, the financial rewards are strong.
Thank you. So moving to the next question, though you've shown this in the PPT, could you just reiterate on the split of sales by various verticals that you did?
Vijay, you want to answer that? So automotive sector is contributing approximately 20% of my revenue. Similarly, consumer industry vertical is also contributing around 20%. Healthcare is contributing around 13% for us during FY22. And then industrial is probably the largest one, which is contributing more than 30%, size. And then there is some bit of IT stages, which is around 10%.
Thank you. Moving to the next question, which is more or less, on the journey of Syrma and, how SGS merged into Syrma and why did they do so and was found it attractive at that point of time. Could you throw some light on that?
So, mentally with Gujarat, we have been partners for almost 4 years. So we could talk and take and very aligned in our thinking about the we were aligned in what we did. We were never competing as such. So it was just aligned from day one, and we really saw the opportunity as being much bigger than what each of us could do alone. So geographically, we were very aligned in the sense north and south coming together. And then in addition, right, when we get to be a bigger company, we are actually more credible with the customer. So they don't need to de-risk themselves. These customers, when they do RFQs with us, right? So if they're buying a certain amount from us, say like a $10 million, they put a cap on us because of our size. They don't want to be more than, say, 30% of a company's revenue. So when we get bigger, that cap goes away and they feel more comfortable with the company and they can also move more business towards us. So that was the main thing. And then secondly, capability, ideology, system, neither of them wanted, both of us were looking for long-term gain. And that's why it just made sense. That's from my side. Gujarat, if you want to add something, I'll leave it to you.
Yeah. One of the main reasons, apart from what Sandeep just alluded to, was that we were in the same industrial space, but not competing. In our turnover, there were less than 10 crores of common customers. So it was a beautiful fit. Syrma was a predominantly export-oriented company, very strong in technology. We had a very strong domestic footprint. So it was like a hand-in-glove partnership. And apart from that, the ethos, the ethics, the vision of creating an institution rather than a company was common to both of us. And we felt that it would be a trendsetter of a collaborative effort to take care of the emerging opportunity. That was the sort of background philosophy of this project.
Thank you, sir. Moving to the next question, which follows, is how much is the total capital that was used to actually take over the two companies, and approximately what is the PAT that we have generated till FY22 from these JVs and acquisitions that we've done?
So actually, it was not a JV. These were acquisitions which were concluded sometime during FY22 only. One acquisition we did completed sometime mid of September of 2021, and another one is sometime mid of October, that is again of 2021. Total payments for both the acquisitions put together was approximately 450 crores. And PAT is something like it was not completely added during that particular financial year because these companies got consolidated only for the relevant period after mid of September and after mid of October. So overall PAT is not actually reflecting in my overall consolidated financials.
Okay, sir. We'll move to the next question, which asks about why the reduction in the IPO price to 20 from 290, given the pre-issue placement.
So, I mean, the price and the valuation we leave to the bankers to decide. We are not experts. We know our business. We don't know valuations. So when we did the pre-IPO, that was the fair valuation that they felt we should be at. But, we really want this milestone to be covered, and we want to be fair to all investors. And, pre-IPO investors are also long-term investors. So they see this, the uncertainty that came about in the IPO markets, and there's been no single IPO for the last 80 days plus. They felt this was the right price, and we take the guidance from them on what they feel is the right price. So our investors are long-term investors. In fact, even our PE investor is not selling a single share in the OFS because we believe this is a long game, not a short game.
With respect to policy, sir, do we have any kind of an inventory write-off policy or a hedging policy?
Vishal, do you want to take that?
We have an inventory write-off policy based on the usage, or if the product is not being used, we write off and charge it off the P&L year, such that we don't carry any inventory over to the next year. It's done based on the assessment of the inventory we carry, its usage, whether the customer is still there or not. So every year a write-off is done in the books. And that's been the practice in both the companies for a number of years.
If inventory is a risk to carry, we rather take the hit early than later.
Yeah.
We try to take the hit and move on. If something happens.
Moving ahead to the next question, which asks for clarification on the differences in the financials between the restated consolidated financials and the pro forma against financials across the key parameters of revenue, expenses, gross profit, EBITDA, and net profit after tax.
And speaking in my previous also, consolidated financial or restated consolidated financials really capture the financials of other subsidiaries for the relevant period post my acquisition of those companies during the last financial year. While the pro forma consolidated financials capture it as 100% of all those subsidiaries together, and that company being there as a subsidiary at the start of the financial year. So that's how the overall pro forma consolidated financials have been calculated, and that's where the difference is between consolidated financials versus pro forma consolidated financials.
Thank you. So moving to the next question, given that the mobile segment is a massive opportunity, are you planning to tap it?
As of now, no. Opportunistically, we see other opportunities that are more suited to our capabilities. So we are focused on those.
Thank you. Next question being, how are your prices compared to your imports?
I didn't understand that.
This is a very tricky question, but we can move.
So basically, we have contract, we have transparent pricing with our customers. So what our price of product is being shared with the customer. So maybe I don't understand the question.
We'll move to the next question. So with respect to the PLI, what are your capex and revenue requirements, and how many years are these benefits expected to grow?
Raj, you want to take that?
Yeah. So we have got two PLIs. One is for the telecom, one is for the white good, which is the air conditioning controls. That's the two PLIs which we have got as of date. These necessitate investment of that certain amount of minimum investment every year, which is 20 crores for telecom and 10 crores for air conditioning over a period of 4 years. And then there's an incremental revenue which we have to generate on that investment. And on the incremental revenue, we get a PLI of 6%, average is about 4.5%. While the revenues have been factored in our budget estimates, we have not considered the PLI because we consider it as a marketing expense which the government is paying to acquire customers.
Thank you, sir. We'll move to the next question, which is what are the usual capacity utilization levels for the plants? Also, do we get impacted with the shortages of the semiconductor chips?
Vishal, you want to take that?
Typically, our plants work at 65 to 75% of the capacity, and once a particular plant or a particular thing reaches 80% capacity, we plan for the next line to be installed. Now, the component shortages has resulted in sort of a skewed sort of production in months, because at times you have good components, the lines are lying idle, while towards the end or during the middle of the month, the components come in, you have to work overtime. But on an average, we work at about 65 to 75% of the capacity.
Okay, so next question being, what has the impact of COVID been on your business? And how have you got out of it?
So do you want to take that?
So COVID has been very challenging for us. 2021, we had almost 70 days of plant shutdown. So that impacted us dramatically, especially with customer confidence. So that was one thing that we had to, work through, bringing workers back, managing the supply chain. That was challenging times. So 2021, we actually lost about 65 to 70 days. 2022, again, in the beginning of the year, we lost about 20 days to just general chaos in COVID. And then over the run of the year, the supply chain issues became very complex in the sense of, incomplete products coming in, which would not result in us being able to make shipment because one part is missing and you couldn't ship. So it did hit our inventory levels quite hard. We are seeing improvements over the last few months. So we are running a little better on the material supply. But that's how they did it. It's very hard to say, what the number impact would be, but I mean, in both places, margin as well as top line, it did hit us. Even the China shutdown hit us in the month of February and March last year.
Moving to the next question, sir, which is on the margin volatility. So could you give reasons for that also? Could you indicate from a margin perspective, which of our business segments give us the maximum margins?
So Vijay, you want to take that?
So when you say maximum margins, like gross margin varies from different segment to segment, but ultimately even after gross margin, there is a different variable cost which we incur for different industry verticals. Practically speaking, healthcare industry is giving you a higher gross margin, but definitely the labor cost in that particular industry is higher than the other industry that way. So margin wise, I would say at the EBITDA level, there may not be much difference between industry verticals, but yes, at a gross margin level, there are significant differences.
Traditionally, the question that's been asked is, as we know, how much time does it take to push the hikes in the margins across to your customers?
What was the question?
So generally, there is always a pass-through is what we agree with the customer in our overall agreement with the customer. But yes, while in the supply chain, once we face those issues related to increase in the prices and all, we have to get the invoices collated and all, and we generally discuss on a quarterly basis with the customer with respect to the pass-through of the increased cost. Many times, today's scenario, the supply chain constraints are actually much more critical. So many times we take a prior approval from the customer before actually procuring the raw material at a high. That is also a practice.
Over with respect to revenues coming maximum from the export segment, do you think that, the same run rates going to continue, or do we have a focus on export plus domestic going forward?
So we have a focus on growth, but yes, exports continues to be a very important segment for us. But it's hard to predict what program takes off faster. So sometimes something takes a little longer. But our endeavor is always to keep this balance of 50% export, 50% local. But it's very hard to plan and take projects that run faster and projects that run slower.
And what is the gestation of the projects generally?
Gestation typically is a minimum of about 12 to 18 months from when we start. So it's a long gestation period.
Right, so we'll just wait for some additional questions to come in from the attendees. So there's a question which is with respect to the management in terms of your involvement and Mr. Gujal's involvement actively, in the business. So could you just give clarity on that?
So I run as chairman. My goal is vision and general strategy where we want to go and how we want to get there. I'm not a daily operating manager. Gujalji on the MD side is driving that, and in addition we have a CEO, Dr. Shira, who's driving day-to-day operations very strongly, and we have a layer below that is very strong in North and South, as well as design capability we have. So my role is more strategy and vision and pushing the general org to the next level that where we want.
Thank you, sir. Any particular reason why the contribution of your top 5 customers saw a decline? Is this a regular affair?
So actually, overall revenue has increased for us from 900 crore to 1284 crore in FY22. So that's where you can see the maximum growth has come from new customers also. So that's why the top 5 customers' contribution is currently around 29% because of the higher growth on the other segment side. It is actually not a decline. It is a relative percentage of overall total number.
I'll just try to add on to what Vijay said. A customer which has just come to us in FY22 or 21 would mature in 22 at a high level of customers. So the growth of the new customer in the second year of his association with us is much higher because the base is smaller. So it's the percentage of top 5 customers will have come down, but in absolute terms, they will still go down. It's just that the new customer with a lower base grows at a higher base. That as a relative thing, it shows a decline as a percentage.
Thank you, sir. Moving to the next question with respect to EVs, that how the government has been increasing the use of EVs. Do you manufacture controllers for the EV battery management systems, and how do you see the growth there?
Gujalji, you can take that.
You see, we were one of the early entrants in the EV space, and the two-wheeler EV space has really taken off much faster than what we expected. And we are today associated with a handful, more than a handful of two-wheeler EV players where we are supplying the battery management system, the engine motor control units, the state of charge. So apart from the other products which go to an EV, which we are not classifying as EV because they are the periphery. So we believe the EV segment is poised for a takeoff, and in the current year and going forward, we expect this to be a significant contributor to the growth of the company, more than the combustion side.
Thank you, sir. Moving to the next question, which is on greener electronics and recyclable products. Where do you think the EMS industry is going here?
The area that we are focused more on right now is trying to reduce the power consumption on most of the platforms that we are. So we are actively working with a lot of customers on power consumption reduction. So that is the green part we've taken. As far as recyclability and those are tougher things to attack when you're a contract manufacturer. So we are more to just reduce the footprint of the power consumption of the customer.
Thank you. Coming back to a question on margins, is there a quarterly seasonality in sales and EBITDA margins, or even in terms of net working capital requirements?
Vijay, you want to answer that?
So yes, due to COVID reasons in the last 2 years, we have been maintaining slightly higher inventory, and that is there is incremental working capital investment for us in the last 2 years just to ensure timely deliveries and proper supply chain management. So currently we are running an overall total net working capital days of around approximately 85 days as of now during as on FY 2022.
Thank you. Vijay, I'll just like to add on what Vijay said. This is a cautious decision of the management to stock material because we are single source to our customers. And COVID, I think, though it was a disaster, it gave us the opportunity to showcase our sort of supply chain and win the customer confidence. So it's a cautious decision of the management to ensure uninterrupted supply to the customers, Indian or foreign.
Thank you, sir. Just adding to the question with respect to the customers, as you stated, a question asking how many of the customers who have been with us have been associated with us for more than a decade?
There is one customer which has been associated for more than 32 years. There would be at least more than 12 customers will be associated with more than a decade. 12 to 16 customers will be more than a decade. Once a customer comes to us, he doesn't go back. We don't allow him to go back. We have not lost any significant major customer during our existence. Until the customer is holding up and is backed up, become bankrupt or gone out of business. Otherwise, then the customers are with us.
Thank you, sir. The next question being again with respect to how are we managing in the space where there is semiconductor shortage?
Okay. Well, as Sandeep was explaining, COVID was again a crisis, but it gave us an opportunity to show our commitment to our vendors also, not only to our customers. Though the plants were shut for maybe 2 months, we ensured that the payment to the vendors was paid. There was no default of the payment to the vendors. We ensured that the commitment of lifting material from the vendors, wherever the vendors were in the position to deliver, was honored. Now, this earned us the loyalty and respect of the vendors. And believe you me, in today's scenario, a vendor is as critical as a customer, especially in times of the crisis of semiconductors. And because of our bodies of the commitments, we have got preferential allocation of components from the vendors, from the distributors, from the manufacturers during this crisis, which erupted from somewhere in October 20, and it's been now almost like 20 months.
Thank you, sir. We'll end it with one last question with respect to any particular reason why the export orientation or revenues from export, dwindled and is, at a declining stage right now. As well as, is there any indication that you could give from an order book perspective?
Yeah, you want to answer? Sure, I will.
Yeah. You see, growth, we have again, I'll just take the macro picture. We have a fairly de-risked model. Export versus domestic, RFID, ODM, spread across industry verticals. We're not dependent on any one thing. Now, for all the arms of a business to grow in tandem, is a wish list which I wish it could be fulfilled. So, if my domestic business, for example, gives me opportunity to grow, the exports in absolute terms will grow, but as a percentage would cut down. So it's a call of the management.